Picture this. Every 4 years, the amount of new Bitcoin entering the market gets cut in half. What kind of impact do you think that would have on its value? Welcome to the world of Bitcoin halving, a defining moment in the life of the cryptocurrency market. This event, which roughly takes place every 4 years, is a kind of seismic shift for Bitcoin, creating waves that reach far beyond its own ecosystem. Why is this event so significant, you might ask? Well, it's all about supply and demand. In the simplest terms, Bitcoin halving is when the reward for mining new blocks on the Bitcoin network is divided by 2. This effectively cuts the rate at which new Bitcoin is created and released into circulation. It's a bit like a digital gold rush where the amount of gold discovered suddenly gets halved. The anticipation and speculation surrounding this event are palpable. Some liken it to the anticipation of a major sports event or the release of a new blockbuster movie. The reason behind this hype is the potential impact on Bitcoin's price. Historically, halvings have been associated with significant price fluctuations, making it a hot topic among traders and investors. The impact of Bitcoin halving is not limited to Bitcoin itself. It can have far-reaching effects on the broader cryptocurrency market. Other cryptocurrencies, known as altcoins, often mirror Bitcoin's market movements. Therefore, a surge in Bitcoin's price following a halving can trigger a ripple effect across the entire crypto market. However, it's worth noting that while the past may give us clues, the future is never a guarantee. Cryptocurrency markets are notoriously volatile and influenced by a myriad of factors. Bitcoin halving is just one piece of this complex puzzle. So the Bitcoin halving is a major event, but what exactly is it and how does it work? To fully understand its implications, we must delve a little deeper. So let's unpack this intriguing phenomenon. Up next, understanding Bitcoin halving. Stay tuned. Bitcoin halving isn't a complex financial term or an advanced mathematical concept. It's a fundamental part of Bitcoin's design. Let's start with a quick look at Bitcoin's nuts and bolts. Bitcoin is a digital currency and it's created or mined by powerful computers solving complex mathematical problems. This process is called mining, and the people who own these computers are known as miners. Now, miners don't just mine Bitcoin for the love of it, they are rewarded for their hard work with new Bitcoin. This is what we call a block reward. At the inception of Bitcoin, this reward was 50 Bitcoins. It seemed like a fair exchange for the effort and resources miners put into the network. However, Bitcoin has a finite supply. Only 21 million Bitcoins will ever exist. This scarcity is a crucial part of its value proposition. But how do we ensure this limit is upheld while still incentivizing miners? Enter Bitcoin halving. Bitcoin halving is a pre-programmed event in the Bitcoin network's code. Roughly every 4 years, or every 210,000 blocks mined, the block reward miners receive is cut in half. This is why it's called halving. This process started in 2009 when the block reward was 50 Bitcoins. The first halving occurred in 2012, reducing the block reward to 25 Bitcoins. The second halving in 2016 saw the reward drop to 12.5 Bitcoins, and the most recent halving in 2020 brought it down to 6.25 Bitcoins. Bitcoin halving ensures the slow, steady release of Bitcoin into the market, upholding its scarcity and value. It's a bit like a digital gold rush, with the amount of gold discovered becoming less and less over time. Now that we understand what Bitcoin halving is and how it works, let's delve into its effects on the broader cryptocurrency market. Bitcoin halving doesn't just affect Bitcoin, it sends ripples across the entire cryptocurrency market. Let's dive into that ripple effect. When Bitcoin undergoes a halving, it inherently becomes scarcer. As the reward for mining new blocks is halved, the rate at which new Bitcoin is created slows down. This scarcity can lead to increased demand, and if demand outstrips supply, we typically see price increases. As Bitcoin is the proverbial big fish in the cryptocurrency pond, what happens to it has a significant effect on the other fish, the alternative coins or altcoins. You see, Bitcoin's price movements often set the tone for the rest of the market. When Bitcoin rises, it can pull up the value of altcoins, creating a positive feedback loop. This is known as the halo effect. But wait, it's not always roses and sunshine. There can be negative impacts too. If Bitcoin's price skyrockets, some investors might pull their money out of altcoins to ride the Bitcoin wave, causing these altcoins to dip. This is a phenomenon known as Bitcoin dominance. Now let's talk about new investment opportunities. Halvings can trigger market volatility, and where there's volatility, there's potential for profit. Savvy investors can take advantage of price swings to buy low and sell high. Moreover, the increased attention that Bitcoin receives during halving events can bring new investors into the market. This can result in a flood of money into altcoins as well, creating a surge of growth in the wider crypto market. It's a game of chess, really. Each move, each halving, can change the state of play, opening up new strategies, new risks, and new opportunities. So, with all this in mind, how much of your portfolio should be in crypto assets? Well, that's a question we'll tackle in the next scene. The answer? It depends on your risk tolerance, investment goals, and understanding of the crypto market. But that's a conversation for another time. For now, let's just say that the effects of Bitcoin halving are far-reaching and can create a ripple effect of opportunities in the vast ocean of cryptocurrency. There's no one-size-fits-all answer to how much of your portfolio should be in crypto, but there are some general guidelines you can follow. The importance of diversification and risk management in investing can't be overstated. It's like juggling. You don't want to have all your balls, or in this case coins, in one hand. Crypto is a volatile market, so spreading your investments across different assets can help manage risk. When it comes to portfolio allocation, it's essential to consider your financial goals and risk tolerance. Are you a high-risk, high-reward type of investor, or are you more conservative, preferring steady growth over time? Your answer will shape your crypto portfolio. Maybe you're aiming for a 10% crypto allocation, or perhaps it's closer to 50%. That's a decision only you can make. Remember, the key to successful investing involves careful planning, diversification, and a clear understanding of your financial goals and risk tolerance. Stay informed, stay smart, and stay ahead in the world of cryptocurrency.